It's 9:17 on a Tuesday morning. You're sitting at the kitchen table. There's a tax document in front of you, coffee going cold to your right. The house is quiet, and you're staring at a number that doesn't make sense. You took $20,000 out of your IRA last year, a trip with the grandkids, something you earned, something you planned for 30 years, and the IRS is treating it like you made over $30,000. Your Medicare premium went up. A chunk of your Social Security, money you paid into for 4 decades, is now being taxed. And your accountant is telling you this will follow you for the next 2 years minimum. You did not make a bad investment. You made a bad sequence decision. And nobody told you there was a difference. Here is the cold reality most retirees discover too late. The financial system you spent your entire career building was designed for accumulation. Save more. Compound more. Wait. That system had clear rules, and you followed them perfectly. But the distribution system, the system you are now living inside, has an entirely different set of rules. Rules about which account you pull from first. Rules about which dollar does the least damage when it leaves. Rules the IRS has never advertised, that most advisors only mention in passing, and that the average retiree figures out approximately 3 years after they needed to know. You are not managing a retirement. You are navigating a tax exposure event that will repeat itself every single year for the rest of your life, and you have been calling it discipline. Before you can change the sequence, you need to understand why you defaulted to the wrong one. Your brain is running old software on new hardware. For 30, 40 years, one program dominated every financial decision you made. Psychologists call it loss aversion, identified and clinically documented by Daniel Kahneman and Amos Tversky at Princeton, later forming the foundation of Nobel Prize-winning behavioral economics research. The core finding? Humans feel the pain of losing something at approximately twice the intensity of the pleasure of gaining the same amount. Which means the program your brain built during the accumulation phase was wired at a neurological level to protect the balance, to resist withdrawal, to interpret taking money out as a threat signal. That program was not a flaw. It was correct. For 4 decades, it kept you from raiding the retirement account when temptation appeared. It kept you disciplined when the market crashed and panic was everywhere. It was the right software for the right environment. But you changed environments. You are no longer accumulating. You are distributing. And the same program that protected you is now making you pull from the wrong account, in the wrong order, at the wrong time, because the brain is still optimizing for balance preservation instead of tax efficiency. The result is mechanical and predictable. People with $500,000 in a taxable brokerage, $700,000 in traditional IRAs and 401ks, and $300,000 in Roth accounts, a very common retirement profile, reach instinctively for the largest account, or the most familiar one, or the one their parents told them about. They are not making irrational decisions. They are making perfectly rational decisions inside a mental model that no longer matches their reality. The tax cascade that follows is not bad luck. It is the programmed output of old software running in a new system. Same person, same savings, same retirement date. Watch what the sequence does. Version A. Version A retires with the same profile. $500,000 in a taxable brokerage account, $700,000 in traditional IRAs and 401ks, $300,000 in Roth accounts. They want to spend $90,000 per year after tax. Their combined Social Security, if claimed now, would be $48,000 annually. Version A does what feels natural. The IRA is the biggest account, so they pull from it, year after year. The balance shrinks predictably. The Roth sits untouched. The brokerage account feels complicated, so it gets ignored. By age 73, required minimum distributions begin. The IRS does not ask. It does not negotiate. It calculates the remaining balance, divides it by a life expectancy factor, and tells version A exactly how much ordinary income they are creating this year, whether they need it or not. That forced withdrawal is large, because the IRA was never strategically reduced during the window when it could have been. The forced income pushes combined income well above $44,000. Up to 85% of Social Security becomes taxable. Medicare surcharges activate. The 22% bracket is no longer a ceiling they approach carefully. It is the floor they are operating from. Version A is not in crisis. Version A is simply sending, systematically and permanently, more money to the IRS than the rules require. Every year, for the rest of their life. Version B. Version B has the same accounts, the same Social Security, the same $90,000 spending target. But version B understands something structural. The years between retirement and age 70 are the single most valuable tax planning window in their entire financial life. Income is low. Social Security hasn't fully activated. Medicare surcharges haven't yet applied. The low brackets are wide open and largely empty. So version B does something that looks counterintuitive from the outside. They deliberately take money out of the IRA in years when they don't urgently need it. Not recklessly, precisely. Enough to fill the 12% bracket. Enough to push some of that pre-tax money into the Roth, converted at today's known manageable rate, before the IRS forces a conversion at tomorrow's unknown higher rate. Simultaneously, version B covers living expenses from the taxable brokerage account, where long-term capital gains for married couples fall into the 0% bracket on up to roughly $96,700 of income in 2025. The Roth sits untouched, compounding, tax-free, invisible to every formula that could make other income more expensive. By age 73, version B's IRA is smaller, by design. Required distributions are lower. Social Security taxation is lower. Medicare premiums remain at the base tier. The Roth, now significantly larger from years of untouched compounding, sits ready for the new roof, the car, the medical event, the inheritance, without generating a single dollar of reportable income. Version A is positioned to spend their assets until they run out. Version B is positioned to direct capital with precision for the rest of their life, including what they leave behind. Same accounts, different sequence. The difference is not performance. It is not luck. It is not timing the market. It is the mechanical output of knowing which dollar to pull and when. You felt it in part 3, when version B started deliberately withdrawing from the IRA in years they didn't need to, paying tax now to avoid more tax later. Something in you resisted. Maybe it was subtle, a tightening, a quiet voice that said, "Why would I take money out when I don't have to?" That voice is not wisdom. That is your thermostat. Every human being who has built wealth over a lifetime develops a financial thermostat, a set point their nervous system defends. For most retirees, that set point was calibrated around a simple equation. Balance going up means safety. Balance going down means danger. The thermostat fires when the balance drops. It creates discomfort. Sometimes actual physical discomfort, chest tightening, a low-grade anxiety, the feeling that something is wrong, designed to stop you from crossing the line. The thermostat was your protector. For 40 years, it worked. But a thermostat set for the accumulation phase will actively sabotage you in the distribution phase. The same mechanism that once fired when you were about to raid your retirement fund now fires when you are trying to optimize it. It cannot tell the difference. It only measures direction. When you look at a Roth conversion strategy and feel resistance, when the idea of paying $8,000 in tax this year to avoid $22,000 in tax over the next decade makes your stomach tighten, that is not your instincts protecting you. That is a ceiling you have outgrown, defending itself. The discomfort you feel when the model shows you paying more tax now than you technically have to is not a warning to stop. It is a system update. It is your brain encountering logic that does not match its existing programming and interpreting the mismatch as threat. You are not wrong to feel it, but you are wrong to obey it. Let me give you the exact structure, the 3 landmines. The first is the Social Security tax torpedo. Your Social Security benefits become partially taxable based on what the IRS calls combined income, your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security payments. For married couples filing jointly in 2026, the thresholds are fixed at levels set in the 1980s and never adjusted for inflation. Below $32,000 in combined income, benefits are not taxable. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, up to 85% is taxable. These numbers do not move, which means every year more retirees cross them without changing their actual lifestyle, simply because inflation has pushed their income sources higher while the thresholds remain frozen. A single $2,000 IRA withdrawal at the wrong moment can make an additional chunk of your Social Security taxable. The effective tax rate on that withdrawal stops being 12%. It becomes something closer to 22% or higher once the cascading effect on Social Security is measured. That is not a marginal rate. That is a trap with a mechanical trigger. The second landmine is Medicare's income-related adjustment. In 2025, if your modified adjusted gross income from 2 years prior exceeded $106,000 as a single filer or $212,000 as a married couple filing jointly, your Part B and Part D premiums increase in tiers. Each tier can add hundreds of dollars per month per person. Crossing a threshold by $1 triggers the full tier. And because Medicare uses a 2-year look-back, a large IRA withdrawal or Roth conversion in your late 60s creates a Medicare premium surprise in your early 70s, long after the money has been spent. The third landmine is required minimum distributions. Starting in your early 70s, the exact age depends on your birth year, the IRS mandates annual withdrawals from traditional IRAs and 401ks taxed as ordinary income. The larger those accounts are when distributions begin, the larger the forced withdrawals, and the higher the probability of detonating landmines 1 and 2 simultaneously. This is not hypothetical, it is arithmetic. Your taxable brokerage account generates long-term capital gains on growth. For married couples in 2025, up to roughly $96,700 in combined long-term capital gains and qualified dividends falls into the 0% bracket when other income is low enough. This is your structural advantage in early retirement, a legal, legitimate mechanism for funding significant spending with minimal tax. Your traditional IRA and 401k generate ordinary income on every dollar withdrawn. In 2025, the 12% bracket for married couples runs from $23,851 to $96,950 of taxable income. Above that, 22% begins. Every IRA withdrawal is measured against these thresholds. The math is not forgiving. Your Roth IRA and Roth 401k, once you've met the age and 5-year holding requirements, generate nothing reportable. No ordinary income, no MAGI impact, no Social Security combined income addition, no IRMA contribution. A Roth withdrawal is structurally invisible to every formula that has the potential to make your other income more expensive. The withdrawal sequence. In early retirement, roughly ages 60 to 70, the sequence that produces the best lifetime outcome for most people with multiple account types follows this order. Cover primary living expenses from the taxable brokerage account. Target long-term capital gains that fall into the 0% bracket. This is your lowest cost income source. Add traditional IRA withdrawals or Roth conversions in precisely calculated amounts, enough to fill the 12% bracket, potentially into the 22% bracket when the future avoidance value exceeds today's conversion cost. You are not paying tax you don't owe. You are paying tax at a rate you control today rather than at a rate the RMD formula will dictate tomorrow. Leave the Roth untouched. Every year it sits unspent is a year of tax-free compounding that compounds the value of every future dollar it contains. Delay Social Security to the extent health and resources allow. Tom delaying to age 70 locks in a permanently higher monthly benefit. It also extends the low-income planning window, buying more time for the conversion strategy to reduce the IRA balance on favorable terms. After Social Security activates, the order adjusts. Required minimum distributions are non-negotiable. They come first. Fill remaining spending gaps from the brokerage account. Deploy the Roth only to avoid threshold crossings or to fund large one-time expenditures cleanly. The Roth is your precision instrument. Use it with precision. Once a year, one piece of paper. This is the entire operational system. Step 1. List your fixed income for the coming year. Social Security, pension, annuity, any guaranteed sources. Step 2. Decide your actual spending target, not the conservative estimate, the real number, including the trip, the home repair, the gift you want to give. Step 3. Subtract Step 1 from Step 2. That gap is the number you are funding from savings. Step 4. Locate your tax bracket boundaries. In 2025, know exactly where the 12% bracket ends and the 22% bracket begins for your filing status. Know the Social Security combined income thresholds, $32,000 and $44,000 for married filers. Know the IRMA cutoffs, $106,000 single, $212,000 married filing jointly. Step 5. Fill the gap in sequence. IRA withdrawals or Roth conversions calibrated to your target bracket. Brokerage distributions for the remainder, biased toward the 0% long-term capital gains window. Roth only if needed to stay beneath a threshold you cannot otherwise avoid. Step 6. Review mid-year if something material changes. A property sale, an inheritance, a large medical event. Any of these can shift the optimal mix. The plan is not static. It is a living calculation. That is the system. One annual review, one sequence, one set of numbers to watch. You don't need to rebuild your entire financial life this week. You need one behavioral shift, 10%. A single new reflex that replaces the old heuristic. Before you pull from any account, before you call the custodian, before you initiate the transfer, before you decide which account to reach into, you run one calculation. You ask one question. Which dollar does the least damage when it leaves? That question is the entire system compressed into a single habit. Now go back to that kitchen table. It's 9:17 on a Tuesday morning. There's a tax document in front of you, coffee to your right. The house is quiet. But this year, the number on the document is different. Not because the market outperformed, not because you got lucky with timing, but because last fall you sat down with a piece of paper and ran the sequence before the withdrawal happened instead of after. You pulled from the brokerage first, long-term gains, 0% bracket. You converted just enough of the IRA to fill the 12% bracket, paying a known, manageable, chosen tax rate, and moved that money to the Roth. You left Social Security alone. You watched the combined income number and kept it below the threshold that would have made your benefits taxable. The $20,000 trip with the grandkids happened. The Medicare premium didn't move. The Social Security taxation didn't activate. The cascade was interrupted before it started. The number on the paper in front of you is not larger than you expected. It is exactly what you planned for. That is not luck. That is not a sophisticated financial instrument. That is sequence. That is order. That is the mechanical output of understanding which account you reach into first, and protecting everything else as a result. The accounts you built are the product of decades of discipline. The only remaining question is whether the system you use to withdraw from them is as intelligent as the system you use to build them. This is education, not personal tax or legal advice. Your exact sequence depends on your health, your state taxes, your filing status, and the specific composition of your accounts. Take this framework to a qualified fee-only financial planner or tax professional who specializes in retirement income distribution, and run the numbers against your actual situation. The window is open right now. It closes gradually, quietly, and without warning. The retirees who use it come out the other side with more of what they built. The retirees who don't come out the other side wondering where it went.